If you had $1 million to invest, would you put it all in today or wait and invest it over time? That's the usual debate, lump sum or dollar cost averaging, but I'm not doing either. I'm not putting it all in the market on day one, and I'm not sitting on the sidelines either. In this series, I'm going to show you exactly how I build a $1 million portfolio using that middle ground. The first step is going to move quickly, so here's the structure. I'm going to invest $100,000 into each of 4 ETFs, keep the remaining cash earning interest, and use part of that same cash to generate additional income by selling cash secured puts on top of the interest. Then I'll track everything on a spreadsheet so we can see how the portfolio grows over time. Let's start by putting the first $400,000 to work. I'm putting $100,000 into each of these positions: GLD, SPY, QQQ, and VIG. This gives me a diversified base in the portfolio to start with. First, I'm going to spend $100,000 on SPY. Current share price is just over $624. So that will allow me to buy about 160 shares. Now let's buy $100,000 worth of QQQ. Current share price is just under $585. So I should be able to buy 170 shares and stay in my budget. Now let's add a dividend ETF to this portfolio. VIG is currently selling at $215.60 and pays a dividend of about 88 cents a share each quarter. $100,000 divided by $215.62 tells me I can buy about 461 shares. Now let's round out this portfolio with $100,000 worth of gold. This gold ETF is currently trading at just over $402, actually almost $403 a share. So I'm going to buy 248 shares. So now I have $400,000 invested across 4 ETFs. That leaves about $600,000 in cash, and this is where most investors stop. They either wait or they slowly dollar cost average into positions over time. Instead, I'm going to use that cash to generate income while I wait to buy more shares. I'm going to sell one cash secured put on each of these 4 ETFs at prices where I would be comfortable owning more. If the price drops, I'll buy more shares at a price that I have already chosen. And if it doesn't, I keep the income and do it again. I'm willing to add 100 more shares of gold to this position, but would like to bring in a little income along the way. So I'm going to sell a $400 cash secured put expiring in 24 days, and I can expect to generate about $1,420 for it. It filled at $1,445. I'm willing to add 100 shares of QQQ to this account, but would like to get paid a little bit before that happens. So I'm going to sell a $580 cash secured put that expires in 24 days. I'll get paid $1,296 right now, and if the price pulls back to $580 or below by expiration, I may be assigned to buy 100 more shares. I'm willing to add 100 shares of SPY to this account, but would like to make a little extra money along the way and buy in at a slightly lower price than the current share price of $653. So I'm going to sell a $650 cash secured put. It will bring me about $1,300 today, and I may be assigned to buy 100 more shares paying $650 a share. And now let's sell a cash secured put on VIG with a strike price of $215, expiring April 17th. There is a bid of $3.30 a share and an ask of $5.10. And I can see that the last contract filled at $3.55 a share. So that's what I'm going to ask for. Actually, I'm reconsidering. The midpoint is $4.20. I'm going to see if I can get $390 for this. Now, here's something that most brokerage accounts don't really show very clearly. They'll show you your positions and they'll show you your profit and loss, but they don't show you how all of these pieces are working together over time. So I track it. I track the shares, the options, the income, and how that income turns into ownership. Because the goal here isn't just to make trades, it's to build a portfolio. I bought 160 shares of SPY at $654.17 a share. So I paid $104,667.20. Then I sold a cash secured put with a strike price of $650 expiring on April 17th and received $1,339.34. If I sum up these numbers, I see that I am out of pocket $103,327.86. Dividing this number by 160 shares shows me that my average investment per share right now is $645.80. There is a good possibility that I will be assigned on Friday, April 17th to buy 100 more shares, paying $650 a share. If that happens, my out-of-pocket cost will increase to $168,327.88, and now I will own 260 shares. My out-of-pocket cost at that point will be $647.41 per share. Either one of these outcomes, staying right where I am or being assigned to buy another 100 shares, will result in an average cost per share that is lower than the current share price. And if you're wondering how much collateral I'm using to earn this $1,339, the $65,000 that I am keeping in reserve for 23 days gives me a 32.7% annualized rate of return on this cash. So I'm happy with that return, even if I'm not assigned to buy 100 more shares. Looking at the other positions, right now my average cost per share with gold is $397.17, which is more than $4 a share less than the current share price. And even if I'm assigned to buy 100 more shares, my average investment per share will still be less than $398. With QQQ, this strategy brings my average cost per share to either $578 or $577. Again, a discount from the current share price. And with VIG, that $414 brings down my average investment per share by close to $1 a share. So at this point, the portfolio is set up. We have $400,000 invested, cash earning interest, and positions generating income that may or may not result in buying more shares. In about 24 days, these options will expire, and that's where the real decisions begin. I'll either be buying more shares, keeping the income, or adjusting the positions, depending on where the prices land. In the next video, I'll walk through exactly what happens at expiration and what I decide to do next. Because this approach isn't about predicting the market, it's about making good decisions as things unfold.